So today's topic is a bit of an important one. It is interest rates. So I'm here with Nick Morgan. Thanks for joining us today, Nick.
Thank you, Joe. I appreciate you having me again.
Yeah, you did so good last time.
Yeah, appreciate it.
Hey, so we're talking about interest rates today. And quick reminder, today, this is actually our 52nd episode.
One whole year.
One whole year.
That's awesome.
I don't think we missed any episodes. I think we did one a week for 52 weeks.
That's amazing. And I was here on the 50th one and 1 year anniversary, so I'm happy with that.
Look at you.
Yeah.
Yeah, that's awesome. So we're going to be talking about interest rates. We're going to talk about this young gentleman, our next generation of home buyers, had a lot of questions. Again, I said it'd probably be best just to have you on to ask these questions because these are great informational things that most people want to know about.
Yeah, absolutely. I really appreciate it. And all these questions that I have for you, it's going to be very valuable information to me. And especially, like I mentioned on the last podcast, information that I can give to my peers and my friends that are also wondering about the industry.
Cool.
Yeah.
Good. Well, shoot away.
Absolutely. So, Joe, what are the rates right now?
The dreaded, what are your rates,
Yeah.
right? What are your rates? So that's a great question. We get asked this as mortgage professionals. We get asked this all the time. What are the rates right now? You know, what are your rates? Well, let me start by saying the rates are not necessarily our rates. Yes, I know different lenders might have they might have different rates, but it's also how the rate is packaged. You know, you might see advertisements at your bank that say the rate is this, and then fine print, it tells you in order to get this rate,
Right.
you have to be, 5'11" or shorter. You have to, I'm kidding. That's a made up one, but it tells you the parameters of what you have to do to get that rate. And a lot of people might not necessarily fit into that rate. And so people say, hey, listen, I heard at Bank XYZ, the rate was 5%. I'm like, yeah, but did you read the parameters? That's not you,
Right.
So going back to your question, what are your rates? And that is a good question. And it depends, right? It's the dreaded, it depends, because your rate is built on many different factors. Mm-hmm. So your rate might be different than someone else's. They're like, well, what's your base rate? Well, again, it depends. Well, the base rate is it doesn't matter what the base rate is. It matters what your rate is.
Right.
So in order to get your rate, we need information from you.
Right. And so what are some of those pieces of information that determine your rate?
Great question. Your credit score, big factor in your interest rate. The loan to value, how much you're borrowing versus how much the house is worth. Or in other words, how much you're putting down, right? That might be a determination of your interest rate. There's a lot of other factors, but the big ones are that loan to value, your credit score, and the type of property you're buying will even matter. Right. So there's a bunch of different factors that go into the rate.
Awesome. Well,
And so I'll even take that one step further. You didn't ask me, but that, you said, what is your rates? And a typical response is like, well, what rate are you looking for? Right? Because and it depends on what your goal is with the property. Like if you're going to be there long term, you might set yourself up differently than if you're only going to be there short term, right? So I don't know if we need to get into all those details, but that's understanding what the person is looking for will help determine how you help them find the right rate for them.
Right. So if you're looking to buy a home and you're looking to lock in your rate,
right.
A lot of people are, they have the question in their mind, well, what if the market gets better? What if the rates get better? And I guess my question is, how quickly does it change? Does the market change? Does that rate? Will you even have the ability for it to make a significant impact on your home or your purchase, or should you just not play the market in general? Right? What would be your advice be?
So, anyone who says they know what rates are going to do tomorrow is either delusional or lying or both. We can make educated guesses on what the rates might do tomorrow, but it's all speculative. Who knows what's going to happen tomorrow? There could be a catastrophic event. There could be a war could break out somewhere. A pandemic could break out somewhere. But for anyone to say, looking at today's data, rates are going to do this tomorrow, they're not being very. If they could predict that with some decent certainty, they'd be having this conversation from a yacht somewhere. Because then you could play the market. Right. So the first thing is you shouldn't play the market. The best experts in the world don't get it right most of the time. That's why markets exist. And so if you don't know what it's going to do tomorrow, right now we are in a raised rate environment. No idea when rates are going to go back down. They definitely will go back down. Is it going to be tomorrow, next month, next year, next decade? No one knows, right? So you have to look at where the rates are today. Now, what was the second part of that question? There's many
just
parts
how quickly the market changes.
How quickly the market changes. The market could change. It might be static for a day or two, or it might change hourly, right? It depends on what else is going on. And so what really that prompts me to answer is what drives the market, or what determines the interest rate. Sorry for asking your questions, but
right. So I would assume that'd be the Fed. It would be my guess, as they create the overall generic interest rate, is my understanding, but I could be completely wrong, and that's why I'm here.
Yeah, good. I'm glad you said that, because a lot of people say, well, the Fed raised the rates, so obviously their rates went up.
Yeah.
The Fed doesn't control mortgage interest rates, okay? They control what's called the federal funds rate, and that's the rate at which banks borrow money, which impacts short-term lending, things like credit cards, car loans, even student loans in some degree. And so you've heard of the prime rate? Well, the prime rate is the Fed's rate plus a certain margin equals the prime rate, and that's usually the base of lending at banks. But it does not determine long-term mortgage interest rates. So now, but if the Fed says, like the last Fed meeting, the Fed said, look, we're not raising the benchmark rate. We're going to leave it alone. So they're like, yes. But then they had to say, well, but we foresee rates being long for a longer period, or being high for a longer period of time. Well, you think about this. Does a bank want to lend money at 5% if inflation's at 7%? No, right. So yeah, sorry to put you on the spot. They don't, because then they're going to lose money. Then let me take a step back. So when we close a loan, that loan gets packaged up and sold, and it ends up, for the most part, at Fannie Mae or Freddie Mac, right? And they pay us for that loan. That's how we make money. That's how lenders in general, the majority of them, make money. Yes, some people make money by servicing the loan, but they still might sell that loan to Fannie Mae or Freddie Mac and just hold on to the servicing. So the servicer is who you make your payment to. But the rates that we get are determined by when Fannie Mae and Freddie Mac packages up or collateralizes those loans and sells them as bonds in an open market. Okay, so if you're a fund that wants a fixed income instrument, in other words, a bond that pays back a certain return, a certain rate of return, you might buy mortgage-backed securities. Okay, and that's a guaranteed rate of return. The bond might be 4, 5, 6, 7%, depending on the bond itself, or higher, depends, right? Whatever the market is. But if you want to buy those bonds, that's going to raise the price, right? And it has an effective decrease in yield or the interest rate. But if people are selling those bonds because they don't want them, they don't want those bonds, right? So they sell them. Well, the interest rates are going to go higher to attract people back to buy them. So to put it at an easy package is that people don't really want fixed income instruments at 5, 6, 7% if inflation's at 8 or 9%. So they're selling them. And by selling them, the effective yield or the interest rates are higher. So that's why we're seeing rates go up, is because there's not a huge market to buy those bonds when they think inflation is going to last longer than it is.
Right.
So mortgage rates are rising.
I got you.
Yeah. Or risen.
Long story short.
They have risen.
That was a lot, but it was a lot of good information, and I really appreciate the detailed answer.
It's a complex topic.
It is. Yeah. So if I was a consumer and I come to Morgan Financial and I'm looking for a quoted rate on my mortgage, if I get a rate from you at Morgan Financial and then I get a rate from ABC Mortgage Company, would I be comparing apples to apples? Are they using the same information? What goes into that rate that those companies are giving me?
If we give a quote today and the borrower goes out and shops and gets a different quote tomorrow, is that a fair comparison? The answer is no. Because neither are locked, right? Like we didn't lock with us. And so if they did their shopping and their shopping was on different days, they're going to get different rates on different days. The market changes hourly, daily, definitely, sometimes hourly. Sometimes they close the market and stop allowing you to lock interest rates because the rate, it's so volatile that day. Just like sometimes if some news comes out in the stock market, they'll actually shut down trading sometimes, right? Have you ever,
Oh yeah.
Yeah, it's happened. Okay. I know you follow those things.
Right.
So just like on that, mortgage rates are different day to day. So it's always best to get rates pretty close in time to one another. And if you get a rate from us today and tomorrow you get a different one, it'd be best to ask whoever lender, hey, are the rates the same as yesterday? Or are they better or worse? So it's not a fair comparison now, day to day.
Yeah. So in that case, you're saying it would have to be, you would have to ask at the exact same time.
Perfectly, yes.
Yeah, perfectly. Everything would have to line up. And then even then, a lender has different investors that may offer them different rates and
sure.
so on. So.
Well, it's also, I mean, the cost of money is about the same for all of us. It really depends on how that loan is packaged up, so to speak, and sold to the client.
Okay.
Right. You didn't ask me about points or anything like that, but one thing that a lot of people don't understand is that as a loan officer, a mortgage loan originator, they don't care which rate you take. They don't get paid any more or less depending on the rate. And so a lot of people think that. They think that, this person's charging me points because they're just going to make more money, or they want me to take a higher rate because they're going to make more money. Mortgage loan originators, licensed mortgage loan originators, cannot get paid based on the profitability of a loan.
Right.
They get paid, especially here at Morgan Financial, we follow the law to a T, but they're going to get paid the same percentage. It's a percentage of the loan amount is what they get paid, a very small percentage of the loan amount. And that's how they get paid. So they don't care what rate you pick. It's all the same to them.
Right.
And so the rate, you say, what's your rate? And I always like jokingly say to people, it's like, what rate do you want? I can get you realistically, a lot of different rates. It just depends on what you're willing to pay to get that rate,
right,
or be paid to take the rate. And right now the market's not paying a lot of what we call overage. Like, if this rate costs you nothing, like in other words, there's no points associated with that rate. It used to be I can give you a higher rate and give you money back to help you with your closing costs. We talked about, we talked about earlier, if you're going to be in the house short term, we'll take our money.
Right.
You're going to make out ahead. If you're going to be in the house long term, pay to buy the rate down because it will benefit you over time.
Right. Yeah, that totally makes sense. And that's a good point. I didn't know you could get money back on the rate because, I've only been, here maybe 10 months now, and I have never, it's all discount points, almost every single loan file.
Right.
People are buying down the rate. So I didn't know it could go the opposite. And so that's really interesting.
Not to confuse the topic, but, right now there's very few rates without paying points to get the rate.
Yeah.
And the reason is think about it, if you're lending money, if you're a lender, who we sell our loans to, or Fannie Mae or Freddie Mac, if you think the loans are all going to be refinanced in 1, 2, 3 years from now, you're going to want your money up front.
Yeah.
So they're going to want their money up front, and so that's why their rates are skewed towards paying points, and points will get you a big discount right now.
Yeah.
Whereas they used to get you about 1 point is 1% of the loan amount. So $100,000 loan, 1 point is $1,000, right? Did I do that math publicly correctly?
You got it.
Okay. And so so I look at it as the that's the cost to buy down the rate. Now, right now we're seeing, 1 point get anywhere from 3/8 to maybe even 0.5%. There's a wider spread. So there's an advantage to the customer paying points right now, or at least looking into it. Depends on the situation, credit scores, loan to values, all these things. But I would at least, I know here we're trained to give them options. Like here's, if you want to pay 1 point, 2 points, 3 points, what that would look like. And when people say, well, I don't like paying points, that doesn't make sense to me. To me, It doesn't matter if you like it or not. It is a function of math. So it's a function of math, and we look at the cost versus the benefit. So how much does it cost to buy it down, and what deduction in your monthly payment do you get for it? The cost is the buy down, the deduction is your benefit, right? And we just, what is the payback? How many months would it take at that benefit to pay back my cost? And then after that, it's almost like your pure profit.
Right.
If a $1,000 payment could get you a yearly return of $500, would you do that?
Absolutely.
I would, for sure, right? If I'm going to be in the house for at least 2 years, it made sense.
Yeah.
Now, if I'm at 3 years, that $500, you're getting a 50% return on your money for the next 30 years. It's really hard to argue that point. It's math.
Right. So. Exactly. It's just when do you start making money, basically?
Yeah, exactly.
A function of time.
Well, that's the cost versus the benefit, the break-even point, right? So on that one, that suggestion, I said if it's $500, you say $500 a year. Yeah. Well, it's 2 years, 24 months.
There you go.
That's a no-brainer unless you're going to leave the house in 19 months, or less than 24. So
perfect. Well, one question I did have, I'm not sure if you mentioned it. You were talking about a point now gets you 3/8 to 0.5%. What were you saying it gets before?
Well, standard rule of thumb is 1 point, 1% of the loan amount. Standard rule of thumb is a 0.25% discount in the rate. That's a rule of thumb, so it could change, But right now we're seeing it sometimes it's that, sometimes it's a greater spread. Like it might be 3/8, 0.5% less on one point. So it's always good to make sure your loan officer looks up and down the rate sheet.
Right. Absolutely. What, in your experience, was the most a discount point affected the rate? In your experience selling, or maybe with a loan officer, that you've seen a discount point go for?
That's hard to say. Like, I know a couple months back we were seeing some crazy numbers, like almost a full. There was one time where 1 point got almost a full percent. It was like, but that was like a perfect scenario of the day and like the time and the stars aligned, and we're like, that didn't even make sense. I'm like, that was the biggest no brainer of all time. Like, pay that. It might have been a little bit over a point, but it was close, and it got like, but that's not normal. That's not typical or normal.
What went into, like, if you can speak on it, I don't know if you can remember what went into the stars aligning for that one.
Oh, it just happened that day, the rate sheet. I mean, it was like the point. So when you look at a rate sheet, you'll see like the interest rates, and then you'll see next to them pricing for those rates, and whether it's going to cost the borrower money or pay them money. And typically it's been costing, right? And so the spread was just so thin. I'm going like this because I can just see it on my screen.
I got you.
But the spread was so thin, and like, it was a big jump between, I'm going to make up numbers. Let's just say it was 7.5%. And then 7.375 was like, almost, it was almost like half a point to get 1/8. Mm-hmm. And then it was like very little adjustments all the way down to like 6.5 or maybe 6.75%. So like 3/4 of a point difference, I think. And it was only 1 point. And that was a huge, huge spread. It didn't make any sense to have them, go down a quarter or an eighth. It made them more sense to go all the way down the rate sheet.
Right. Just take the jump.
And that is not normal or typical.
I gotcha. I gotcha. Okay. So if I'm in the home buying process,
right?
I have contacted my lender. I'm not locked in my loan or anything. I'm under contract. Where in the process when in the process should I lock down that rate?
Oh, okay. So you have a contract, right? You already know the lender you're using. You're just looking to lock in the loan.
Right.
All right. So this is a great question because you have to have that contract for the most part to lock in a loan. And I would not wait. There's a lot of people that say, well, I want to see what the market does, or I want to play the market. And let me tell you, there's nothing worse than regret, and FOMO. And some people, I've heard this, I just want better information. The better information they're seeking is future telling. It's impossible. Like I said earlier, you don't know what tomorrow holds. It is truly gambling. If you're not locking your loan today,
right,
you are gambling that it's going to get better. And the likelihood of it getting better, it's possible, but it's not likely. Is it going to get worse? It's possible. So if you like what you see, lock it right away, okay? Don't wait. Otherwise, you're gambling. I'm not very good at gambling, okay? I don't like losing money, and I suspect a lot of our clients don't either. And the opportunity to win is a lot lower than the pain of loss. Because we've seen rates. We had a borrower recently, didn't want to lock his rate, wanted to see what the market did. I told the loan officer, you probably need to have that conversation that, look, they could get worse, significantly worse. And they went from costing like $1,800 for the rate they liked to costing like $3,800 in one day. So that was what, $2,200 or somewhere around there, $2,200 in one day changed to the rates. And that wasn't even a huge market move. It was a bigger loan, but $22 to lose for no reason, it's senseless. Now, if the rates get significantly better, we could potentially renegotiate the rate lock, but that's something that we have on auto, they will automatically alert the borrower if they get significantly better. In most cases, not all. But to not lock a rate is dangerous and reckless. Okay. So we always tell clients, look, today is a good day to lock the rate. When's a good day? Today. It's not because for any other reason other than there's nothing worse than it getting worse tomorrow. And then what's the client want to do? Well, let's see what happens tomorrow. Well, what if it gets worse again and again? It doesn't care about you and your losses, right? It's the market. You can't control it, So the best time to lock a rate is the second you can. I wouldn't wait. I'd make sure you're done shopping. You've committed to a lender and you said, this is who I want to go with. I'm good at that rate. Let's go ahead and hit the lock button.
Right. I gotcha. And then how much? So let's say, it's 2 months from closing and you do have someone that's like, well, I want to play the market. I want to I want to take my chances. I want to gamble, which you would advise against. But, you know, like you were saying, in one day, it changed $2,000.
Drastically, right?
How much, you know, what is the potential downside for waiting 2 weeks, for example?
I'll give you a really good example. If it is April of 2022 and you said, ooh, I want to wait. Well, the rates went from the 3s to like 7s consistently over the course of a couple months.
Right.
So that's like a pretty bad worst case scenario. And you know, I don't think rates are going to go from where they are now to 5% higher.
Yeah.
But it doesn't take a lot of movement right now to make that rate much more expensive. So if you're okay with, if you've done your shopping, you found your lender you like, and you're okay with it, go ahead and lock. Now, if your time frame is longer, like let's say you have 6 months, well, that's a different story. If you have 30 days, you know, you need to lock that in. You don't have a lot of time for gyrations. But over 6 months, you're going to see the rates. You know, there's some volatility. There's ups and downs. 2 months even, you might have a little bit of play in there. But inside 30 days, no, you don't want to play around with the market. That truly is gambling.
Right. So I guess in that case, I have a question, because you can lock for, 30 days, 45 days,
60,
90, 60. Yeah. In those date ranges, in that amount of time, which one would you say is most ideal? Well, again, or is it just now?
No, you're what you're asking is how long should you lock the loan for? Well,
right.
If your closing is 45 days away, you don't want to lock for 30 days. It won't get to the closing. So if it's 45 days late, you want at least a 45-day lock, 30 days. So other than that, you just want to make sure you get through your closing date with your lock.
Okay. And
does that make sense?
Yeah.
Okay.
Yeah. I just was wondering if there's any other factors that go into it, or if you would recommend.
If you don't know your closing date,
yeah,
or you think it might be around this time, you might want to overlock it and have extra days. But outside of that, no, you want to just get through your closing date.
Gotcha.
Cool.
Thank you, Joe.
That's it?
Okay. I think so. I think that's all the questions I have for you. I really appreciate all the detailed answers.
All right, cool. Well, I'll just do a quick recap. Like the rates are the rates, but they're not really. You know,
right.
The rates are the rates for you. And so if you're looking to lock in a loan, really, if you wait, it's gambling. You're never going to know what tomorrow holds. So if you have, friends out there looking to buy houses and they're like, when should I lock, Nick? And you're like, as soon as you get a contract, buddy, lock it in. Right. And if people do their shopping, that's great, but make sure you're comparing apples to apples. So if you go to your bank and you see they're offering a 6-point whatever, 7-point whatever, read the fine print.
Right.
And know that might not be for you. That might not be your specific situation. And make sure you talk to somebody to actually, give them your information. If you call someone up and they give you a rate right off the bat, that's reckless and unprofessional. Right. So I would run, not walk, because that's not good information. The likelihood of that changing on you is high. Now, if someone talks to you and finds out your needs, they get some information to you, they understand what you're looking for, and then sends you an estimate, well, that's professional, right? So again, I appreciate your questions. And if you know of anyone out there looking to get better clarity on interest rates, what the rates are, what they could be, how to use them, and all these things, have them call a professional, preferably here at Morgan Financial, but a local professional that's well respected. And that's about it. So thank you for joining us on our 52nd episode. 52. Thanks for joining me, buddy. 52 episodes, 1 year. We did it. We made it for 1 year. Hopefully we'll do it again next year. Put your comments, your questions, like and share this with people that might find value in it. And thanks for joining us this year. We'll see you again next time.